Welcome, everyone, to this episode of the Expansive CEO podcast. I am Hannah Chapman, your host, and today is July 10th. It's Thursday, July 10th. It's 1:27 p.m. where I'm at, which is aligned with Pacific time at the moment, just to put a timestamp on it. So I am here for another Investment Friday with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. And we've had kind of a quiet and not quiet week in different ways, right? There's some stuff coming up, but it's the week after 4th of July. So what's going on, Brad?
Yeah, it's typical of a kind of a summer, right? We're kind of in the dog days of summer, and that applies to the markets as well, where a lot of traders are already on vacation, a lot of asset managers on vacation, and so they have their second in commands taking over and doing the trading. So trading, although depending on certain days can be normal, a lot of days it's a lot more thinly traded than the normal course of during the school year. Um, so we have that. So that tends to, when you have a little more thinly traded markets, typically the moves are a little more exacerbated, right? The moves are a little easier to get on the upside and the downside. Just gets a little more volatile. Particularly, we're just entering this earnings season for the second quarter, right? So
Right.
the next 5 to 6 weeks, we're going to have all of these companies announcing their earnings results for the last quarter, and you're going to see a wide disparity in how investors treat each of these companies and their results. Some are going to do far better than expected, and that is those stock prices are probably going to elevate pretty nicely. Similarly, if a company comes out, has poor results, and or has future guidance that isn't quite meeting this, the smell test, those companies are going to get punished quite a bit. So again, volatility, we're going into the thinly traded July, second part of July market here. And then also to remember for our viewers and listeners, August through October is the worst time for equities in general. From a seasonal perspective, it's the most volatile periods in the marketplace. So don't get too concerned. Volatility is going to be here for the next two, probably 3 months. So let's not get too worried about it. We've had some economic data that has been pretty decent. We've had some low inflation numbers coming in. Even with this week, with President Trump resurrecting the tariff trade talk, with basically his August 1st deadline now. If kind of letting everybody know, if you want a deal, you have until August 1st. Otherwise, they're going on. Okay. These reciprocal tariffs. Now, remember, there's a number of different types of tariffs that have been applied basically since Inauguration Day. So the first is a universal 10% tariff across all countries. All right. So that's been in place for a while, for a number of months.
Mhm.
Then there's these sectoral tariffs, which are in particular on particular items. So for example, steel, aluminum, copper. Copper was a big one that was just applied this
This week.
week.
Yeah.
Okay. And copper is a very, very, very important metal for pretty much everything physical, whether it's home building, whether it's electronics, whether it's autos. It is everywhere, even generating electricity and transporting it. It's Copper is kind of endemic everywhere. So it's a really, really important metal for the economy. So President Trump just applied a 50% tariff on those. Now, the third type are these reciprocal tariffs. And this is what the tariff that President Trump was addressing this week, where he put them on and then he pulled them off. And then we had the July 9th deadline saying, okay, you have a number of months to get, for each country to do these trade negotiations to try to cut a deal so that we could make our trade balance close to zero, right? With each of the, let's get it together, and then we can do a trade deal so that these reciprocal tariffs don't hit you nearly as hard as they otherwise would. So far, we only really have one trade deal in that respect. That's with the United Kingdom, which includes England, Scotland, Ireland, and or Northern Ireland and the like. Uh, and we have a trade framework, not a deal, just a framework with China on how we're going to address the trade imbalances with China. Again, all of those details need to be worked out still with China, but we do have a framework in which we have agreed. Um, so these reciprocal tariffs, August 1st, if there's not trade deals done, then we should see a bigger bite, either to operating margins from domestic companies that import goods from overseas, or or possibly in tandem, higher prices to consumers for those goods. So, if you're buying a new car, new truck, or you're buying a dishwasher, the combination of the aluminum and copper tariffs plus um, the from whatever country they're being made, and plus the 10% universal tariff, that can add quite a bit onto some of these big ticket goods items that households have to buy or buy eventually. So again, it's a one-time 12-month period. I believe the estimate, and I can't find it really off the top of my head, but I believe that the max tariff right now, the average effective tariff rate will be about 15.8%. And we import about 10% of all of our goods. Okay. So that 10%, if you apply 15%, 16%, it's going to add about 1.5%-ish to our inflation rate. Um, Today, this week, as we sit here, Truflation, which is a company that analyzes over 10 million price data points on a daily basis, estimates our inflation rate across the country today is 1.9%. Okay.
Mm.
So 1.9%, adding on 1.5% is a total overall inflation of about 3.4%. Again, easily digestible by the US economy, not something to panic about. So it's something that can be absorbed and adjusted to. But we have to see who adjusts that. Is it companies' earnings that go down a little bit, or is it households that have to pay just a little bit higher price?
So in that discussion, I mean, what's interesting is that, I mean, originally the deadline was like July 9th, I think, right? Yesterday,
Correct.
that we were supposed to have deals done. And then a couple of days ago, Trump came out and said August 1st is when this, so we're just kicking the can down the road is what it seems like. And the market, when I look and see, okay, what happened today? Um, they, it's like the tariff discussion, it's like they don't believe it's relevant anymore, right? Like, oh, he just keeps kicking it down the road, so we don't need to freak out about it. I mean, that's kind of what it seems like the market is saying with how everything performed today, which, we're up at fresh highs again.
Yeah, I agree with you. I think investors, there's really two things. One is everybody is coming to the conclusion that even with that, even if he gets these higher tariffs, a 1.5% to 2% one-time inflation bump, the US economy can absorb. We can handle that. If we start getting more north of 4% on inflation, 4, 5, 6%, that's a bigger problem. In
Mhm.
fact, that's a real problem, particularly for those households who are in the lower income strata. That becomes a real problem. So at this point, if we have less than 4% inflation, 3.5 to 4 for a one-time 12-month event, I think we can absorb that. So I think investors are looking at that and saying, okay, one, we can already absorb it. The US economy is growing, but still slowing at a pretty decent rate. But it's still growing. Okay.
Hmm.
So can we absorb that? Yeah, we probably can absorb that in a pretty decent way. Um, and then secondly, there's that taco theme, right?
Right.
Trump always chickens out. Um, is Trump going to actually apply these? He has start and stopped a lot since the inauguration with different types of tariffs. My guess is he really, really wants to get deals done, and unfortunately, in certain respects, he's really trying. He's finding it more difficult to get trade deals done than I think he anticipated. Um, like I said, the only trade deal that's really done is with the UK, in which the United States had a trade surplus in goods,
Right.
meaning we sold them more goods than we bought from them, which is kind of what Trump wants. Um, and China, which we have a massive, massive trade deficit. We import far more Chinese goods than we export US goods to them. But again, that's a framework. That's not necessarily a done deal.
Hmm.
So there's a lot of devils in the detail with that with China. So I think it's an interesting deal. He threatened a 50% tariff for Brazil, um, which is also an interesting thing because it was more politically motivated. His buddy down there, Jair Bolsonaro, is being investigated for corruption and all the different things when he was president of Brazil, by the current president, Lula, who is on the opposite side of the political spectrum from Bolsonaro. So I think Trump is trying to defend his friend a little bit, threatening 50% tariffs, it, irrespective of their trade balance, because the U.S. has a trade surplus with
Mm.
Brazil,
Okay.
meaning we buy far less Brazilian goods than we export to Brazil. So again, another country, if we do it, that the trade, I think the trade is a secondary consideration in that scenario. So, or in that particular circumstance. So we'll see.
Yeah, it's very interesting to be here in, July 10th, with how strongly the market reacted earlier in the year and with all the uncertainty to the point where, and again, I think this just goes to show that exact same theme of the markets like certainty. They do not like uncertainty. And now that we have been through a few iterations of tariffs on, tariffs off, tariffs on, tariffs off, I think the certainty that's being projected is that, oh, this isn't actually going to be as bad as what we thought it was going to be, um, because it's just nothing's actually materializing in a substantial way. And so that feels like what the market is like metabolizing about the tariff situation.
I agree. I think part of today's reaction as well, where, the past couple of days where the equity market has run up. For example, today, the Federal Reserve, um, he's a member of the Federal Open Market Committee, which sets interest rate policies for the United States. But Fed Governor Christopher Waller, came out and said today that he thinks the Fed should cut in July.
Oh, interesting.
And so there's a couple things there. One, I think I think a lot of the investors out there are hoping and kind of banking on the fact that the Fed will save the U.S. economy or lower the interest costs. So therefore, um, increase earnings at the same time these tariffs are applied. So effectively, what could happen, and it won't do it exactly. So this math isn't exact. It's Tariffs are applied. Companies pass on a part of the tariff to customers in higher prices. Part of it, they lower their operating margin, meaning they eat that cost, that their portion of the cost. And then because of lower interest rates, that makes up a lot of that earnings shortfall.
Mhm.
So in a perfect world, earnings are the same, customers are paying a little bit higher price, and yet the economy is still growing quite nicely. That's, I think, the perfect world in which investors are trying to forecast. And I don't know if it's going to come out quite that nicely.
Yeah, well, and then in all of that math and in the tariff math, all the math, I think the frustrating part is that it's still the consumer is paying a higher price. Right. And like that's what it keeps coming down to. And that's a part that I think we have to just be like mindful and aware of, right? Because wages are not necessarily keeping up right now with price increases. So if we get these like inflated tariff prices, we have a gap to close still over the last couple of years with inflation and wages, don't we? Or has that started to narrow?
It's a good question. I'm going to look it up really quick because for a long time, to your point, household earnings growth income growth has not been that great. In fact, that's part of the reason we've had this a massive extrapolation on the equity markets is because earnings have grown so much because their labor costs have been relatively stable while still producing the same amount of goods, if not more, right? So that massive labor productivity has allowed companies to earn far more. Um, yeah, so it's growing by roughly, you know, 3 to 4% per year. Okay. Um, so not bad. Okay. If we can have 4% median, the real average growth in household income grows by 4% and inflation grows by 3. Okay, well, I'm already adjusting for it by the term real, right? I'm already taking inflation
Right.
out. So they're still growing their purchasing power a little bit by 3 to 4%. That's pretty doable. Now, the problem with what I'm saying and what you should be calling me out on is we had this massive accumulation from 2021 to 2023
Yeah,
where that accumulated inflation we haven't caught up with yet. And that
exactly.
is exactly the point. And eventually we will catch up with it, but it's going to take some time just as inflation remains low and as uh, household earnings continue to increase year over year, that will eventually right itself. But you know, uh, 2024, 25, it's not going to be the same. People are going to still feel that pinch.
Well, and that just like made me wonder what was it like during, some of these other periods? How long did it take? And I mean, like in my mind, I'm assuming that that's like probably at least a decade long process in order for
Um,
it to right itself, like after the Great Depression or the stagflation in the 70s. Um, do we have any, well, even, I mean, from being from the millennial lens of the graduation, people who graduated out of college in 2008, 2009 into the worst job market in decades at that point, right? The wage gap that was created from that crisis, right? Like it's like, are people going to be able to come back from it within again, within a decade?
um, hmm.
I know I'm asking questions that require research.
I know, and I'm doing it as we speak. So I
I know, it's
apologize if
good.
I'm looking away and
I'll keep talking.
yeah, keep
Um,
talking because I'm I'm trying to find the most updated because it shows particularly, back in the 80s, we can see, how long it took to get back to prior highs.
Hmm.
Um, well, I'll just show you this. This ends in the beginning of 2023. So it does not include 23, 24, and year to date 25.
Okay.
So, but it is good for historic. So if you allow me
Yeah.
to, I will share my screen really quickly. And for those of us who are listeners, we will walk you through what you're going to be, what our viewers will be seeing. Um, Hold on here.
You should be able to share.
Yep. Okay. Do you see my screen?
There we go. Yep.
Okay, so what you're looking at is the FRED database, which is essentially a database housing all of the data from the various Federal Reserve banks around the country. It's housed, or the main Federal Reserve Bank in charge of it is the Federal Reserve Bank of St. Louis. Okay, because they're the ones that developed this database, and it's very, very helpful. But it's helpful for pros. If it would be very boring if you don't really know what you're looking at here. But um, so this is real median household income in the United States. Okay. So this is the median. This isn't the average. So just a reminder what a median versus the average is the median is essentially right in the middle. Okay. Now, people are going to say, well, I thought that's what the average is. Well, the average is, but it takes into consideration all of the outliers as well. So it's heavily influenced by the very, very rich, how much they make, and the very, very poor. Whereas the median kind of mitigates that influence. So it gives you a better central tendency for household income because it's really looking at everybody. Okay. Or
Right.
it's
If it's
looking at the the people in the middle,
Yeah,
for
so
the
if
most
if
part.
you have 100 humans, it's there's, 49 on this side and 49 on this side, and what's in the middle
Correct.
versus how much money does each person make. You can actually do a really good example of median and average with the numbers 1 through 100, but I would have to
Yeah.
I would have to
Well,
do that math. Uh, but yeah, I mean, still, yeah, it's what's out of the number of humans, what's in the middle out of the
yep.
people.
Count it down. It's real easy if it's an odd number. It's a little more difficult if well, it's easy if it's even too, but you can see, so this is going back to essentially 1984. Okay. And if people remember back to 1984, most of us may not, but in 1984, we had very high inflation, but Paul Volcker had come in and started clamping down. And so you can see as inflation came down, the median income, the real median income again, I'm going to remind you, if I say the term real, when it's applied to economics or the financial markets, when we say that term real, it means we've already adjusted for inflation. So it's already adjusted for inflation. Okay. So
Okay.
if you see this line going up, it means that it's growing in excess of inflation. All
Okay.
right. So you peak out here in 1989 at $64,000. We go through a period of slowdown. Okay. We go through a recession and we come back and we basically break even. And it takes about
Like,
7 years, 8 years,
yeah, like
7.
95, huh?
Yeah, 96.
96.
So 96 is a break even. Okay. So 6 or 7 years, you're back to where you were at your peak. And then we continue to grow and we grow. And then all of a sudden in 1999, we peak at $70,210 per household. And then we go through a sliding. And part of that is because we go through a recession, we go through the tech wreck, which again was a um, was a asset deflationary experience where all of a sudden these assets that people thought they had in the Nasdaq and the tech stocks, the internet stocks, they went down a lot. I mean, the Nasdaq went down 75% at one point. Um, and so you peak out in 99 and you are back to 2006.
Okay.
Okay. 2006. So 7 years again, 6, 7 years again, you're back to peak. All right. And again, these are not very high inflation periods. These are really based on what's going on in the economy and those like. Now, if we fast forward all of this, um, we go through the Great Recession, and you can see why the Great Recession was so difficult was because we peaked out in 2007 with $71,200 and we declined significantly, right? And it took, so that's 2007, and it took till 2016 to get back to break even.
Yeah.
Okay. And so this big bowl shape that made that, that kind of did it, it's kind of a big deal, right? For
Yeah.
client or for households. Well, since that time, we've gone up. We peaked at $81,210 in 2019. We went through the COVID crisis, which obviously slowed income growth for households. And then on top of that, we went through an inflation spike, right? We went through a period, 2 years of very high inflation. So that drove the real household median income down even further. So if you're looking at from 81,000 to 77, it's a big drop as a
Hmm.
percentage, right? Over a period of 3 years. And now we're coming back and we're at 80,610. So we're not quite back to our prior peak of 2019, but we should be by now. Again, I have to update this chart to see if we are, but
Yeah, that's interesting. This is my life in real median household income in the United States. I was born in 1984. So
well, I mean, yeah, I think to your point, we went through a double whammy with households, which is why it's difficult for a lot of people. Is one, we had a slower economy because of COVID, right? We shut down the economy, incomes dropped, okay?
Mhm.
Followed by a high inflation spike, and now followed by maybe a 1 year period of higher, but not nearly as high as it was back then, but higher inflation. So it's kind of this 1, 2, 3 in sequence that I think a lot of households, particularly in the the below median, are may struggle with because they spend a higher percentage of their income on goods, and those goods are now going to be more expensive. But all in all, I think we'll 2025, I think we'll probably eclipse the highest real median household income in the United States ever. So we've
Hmm.
set records probably. So
Well, I think one thing that's interesting to piggyback off of that information and to kind of bring it into a financial planning realm is that real income can fluctuate and has, right? So just looking at that graph, right, we go through periods of expansion and then we go through like again, like we saw the 7 years, a couple of times, 9 years to recover from the Great Recession on real incomes. And one of one of the best ways for us to as just if you have a W-2 job, if you are a business owner, one of the best ways that you can get out of that cycle or protect yourself from that cycle is to diversify your investments, is to start as soon as you can with whatever you can do, whether that's, I mean, I've had clients who literally started with, 50, $100 a month when they were in their 20s right? Like putting it away as soon as possible, just a little bit. And that grows over time when you do it consistently. And that helps insulate you from those those waves. Because they can't like I mean I experienced this. I mean my husband and I were talking about this a couple of weeks ago. It's like it feel we feel like inflation has kind of caught up in a few places, um, even just over the last 6 to 8 months. We'd say like going out to restaurants, especially stuff that used to be like kind of like fast casual, where it was like $10 or $11, for a meal. No, we're looking at like $15 to $18 a meal. And it's kind of like everywhere right now. And we have 3 kids who don't always eat off, like at least 2 of them never eat off the kids menu anymore, and sometimes the third also. So we're like we're really feeling it. But that exacerbation, right? Like that's something that we're going to keep experiencing. I don't see restaurant prices going down. It's like we're not going to deflate on our food costs, I don't think.
Well, it depends on where you go. So if you go to, so what you'll see is in lower end restaurants, you'll see those prices come down because the competition is pretty fierce.
Mm,
So if you remember back in the day, Taco Bell always sold, really inexpensive stuff.
yeah.
And you're going to see that come back because they're going to be competing with McDonald's. They're going to be competing with other kind of the base level. However, you and your husband and your family are in an income strata that you probably eat at nicer restaurants a little bit. It may not be Taco Bell, but it may not be Ruth's Chris either. It's in the middle. Okay.
Hmm.
So you're probably going to Chipotle, and Chipotle is going to be more expensive than Taco Bell, but you will see those costs come down a little bit as pressure and competition heats up between them.
Mm. We'll see. Yeah, I don't know. We I'm not a McDonald's fan, but I never have been. But every
Come
once
on.
every once
McDonald's
in
is
a while.
fantastic. MCD on the New York Stock Exchange. Come on.
No, I don't like it. But every once in a while, I do
Well,
need some Taco Bell. So
yeah, I hear you. I hear you.
just every once in a while. They're good. The nachos Bel Grande. Um, but anyway, I wanted to really like just kind of like settle in with that for a little bit too, because sometimes again, when things feel like how are we ever going to catch up, or and I'm saying this because I talk to people who have high enough income, who have enough actual discretionary funds to save and invest, and there can still be that fear of like, but I don't know. I don't know what's going to happen. I don't know what's going to happen with the stock market. I don't know what's going to happen with my job. And so it just feels scary to put it away. And so a piece of that work, a piece of, the financial planning work, and a piece of, really the mindset work with your money is to understand, hey, here's how things actually look right now. Here's how you're actually doing right now. Here's where you want to go in the future. And if we do a little bit of investing here and there, if you start to put money away, you'll start to get used to it. You'll start to feel that, oh, I can do $50 a month. I can do $100 a month. I can do, I can increase my 401k percentage by 1 or 2%. And I'm not actually feeling that. It's okay. And that's one of the ways that we help coach people in, in that regard of how do you get out, again, how do you get out of that income boom or bust cycle? It's you grow the investment side.
What I tell what I tell people a lot is um, particularly as we look at them trying to increase their contributions and their savings and all that is I said, look, start out putting a minimum of, look at your 401k, whatever the percent is, the max that they match,
Right.
put that in. So if it's 4%, put 4% in. Well, the reason why you do that is because one, you save taxes on that, even though let's say you're in the 15% tax bracket. Okay, so you're saving 15%. That's not bad. If Cheerios were on sale for 15% off, guess what? You're buying more Cheerios. Okay, great. But in addition to your 401k, you're putting in 4%, you're saving 15% on that, and they're doubling your investment with
Right.
4% contribution from your employer. Okay. So you're over 100% return instantly. Okay, start there as a baseline.
Hmm.
Okay, next year you get a 3% raise. All right, we'll take two-thirds of that and put it in your 401k and take 1% and increase your month-to-month income. And do that process over about 4 to 5 years. You're already maxing at your 401k and you're growing your monthly after your monthly income so you can absorb it, and you can at that point you can start doing other things. So that's the only way I can see people actually doing it. Anytime I've seen someone come out and say, "Oh my gosh, I need to do it today."
Yeah.
They usually put it in for a couple months and then they pull it off and then they pull it back in and they pull it off, and it never stays with a consistent process. So I'm going to show you a chart just really quick because this is what you've been talking about. So I want to give the viewers a little bit of a you see this, right?
Yep.
Okay. So this is what Hannah's talking about, is this big negative right here. If it's below the line from February 2021 all the way to basically May of 2023, it's below the line. That means uh, households were their purchasing power was going away.
Hmm.
Essentially, they could buy less with the same amount of money. Okay, and this becomes an accumulation of of problems because now you can afford much less over time. Okay. Well, now we're breaking even basically a little bit below, a little bit higher than, but we still need to get a little bit higher than that so we can gain year over year um, gains in wages so that people can live. Now, this is what I'm looking at here is the median hourly wage growth. Okay, unweighted. So that means just all the wages that are being paid per hour, what does it look like?
Hmm.
What's the median? What's the middle? Okay. So this is truly a look at those people who are in the middle, wage earners. So they're not salary earners, they're wage earners. Okay. And these are the people in which this big accumulation here is problematic.
Right.
Um, and eventually, hopefully, this will continue to go back up and compensate for this big. Now, what you'll notice is before this big deficit, we had a big surplus here. And that's from COVID and all the different transfer payments that the government did. And so we saw a massive spike in payments for people for wages. Okay.
Hmm.
Well, so we had this massive purchasing power growth, and then it's obviously since 2021 has kind of dribbled it away, and so now
Right.
we're basically back to break even, if not a little bit lower than break even.
Yeah, and I mean it's interesting when you look at the graph because the spike in 2020 is maybe at like 18% of a
Yeah,
spike, but the trough all the way down to the bottom in 2021 is like 28%.
yeah.
So
Well, if you just
it's
look at the two areas above it, it's the area is one size, right?
mhm,
And the area below the black line after that is a lot that area is much larger,
right,
right? And so that much larger area would imply that wages have declined because of slower economic growth, because of higher inflation, because of possible tariffs, that all of these things are are creating a bit of a problem for the median wage owner, wage holder, wage earner.
Yeah. Yeah. And I mean, again, to pull it back in, that illustration is super helpful to illustrate what we've been feeling. I think it's really nice to have that information and to see it, like it corroborates those, like it feels like we have less purchasing power. Like, well, here's the information for you, and like here's how we can make decisions based on that, right? We get to make more informed decisions as we go forward. And so, again, I would say, like, especially if you're listening and maybe you have kids who are graduating college and going into the workforce, or kids who are getting their first job, right? That kind of thing. Or you're in a place where, yeah, you're about to get a raise and you can make, some of these decisions. It's a really, really good practice to, again, like exactly what Brad was saying, like whatever your employer will match, first start maxing that out. And then just see how it goes. See how it feels in your paycheck. Let it let it go for a few months. And if what should happen is that you should stabilize around that new income number. And then you can see if later on, if something else changes, if you get a raise, if you have a partner and they get a raise, and like, or if you have a side gig, or if you start a business or whatever that is, once you can kind of stabilize around a number, then we push it a little bit. All right, let's try a little bit more. Let's try another percentage point. Let's try another 2 percentage points. Um, and that's part of the work that we even do just normally in client meetings in, you know, all over the place. That's a big part of it. And to your point, Brad, that's a mindset piece that I've had to work on with clients a lot is that, okay, I saved it and now I need it back. And then I save it. And like that cycle of creating a safety net and then going through the safety net and then creating it again, right? That is, it is a financial cycle. Yes. Like there is a component to that where you need that, but it's also an emotional cycle. And there's a pattern there that people get into, and we need to make different decisions in a few different places in order to help you break out of that cycle so that you can put money away and let it grow, because it's that time, that compounding over time
Yes.
is what makes the biggest difference. So if it doesn't get to sit in the stock market for long enough, or the bond market or wherever, if it doesn't get to stay long enough, you're not going to experience the lift. And real estate everywhere, anywhere you invest, it needs time. Time is the most important factor.
Yeah. Time in the market is how people achieve their financial, I should say, time in the market is how most people achieve their financial goals.
Hmm.
Um, there are always the ones that are the outskirts, which make one investment that goes straight to the moon and they make a lot of money. There's always people that own a business that is very successful that can then provide income enough where they can save and catch up. Okay. But I would say in each of those situations, they've also had time in somewhere doing something. You know
Hmm.
what I mean? Whether it's their skill set, right? I have a friend who uh, is an orthopedic back surgeon for pediatrics. Okay. He didn't start practicing until he was 35, 36.
Hmm.
So almost halfway through other people's careers, he started practicing, but he started practicing at an income level that allows him to save enormous amounts of money very, very, very quickly. Okay.
Yeah.
So, you know, it's just some of those things for most people, time in the market is how you're going to get your financial goals.
Yeah. I like that reminder too, though, that time in anything And I believe that wholeheartedly as well, right? It's skills over time, it's wisdom over time. It like time is such an important factor that we want so many of us want to compress all the time. We want even in stock market when we talk about it on a weekly basis, right? It's like we want it to just be good. We want it to just be better. We want it to just be at the high all the time. And that's just not how life works. That's not how reality works. Things, having that ability um, to be patient in a lot of different ways is so, so important.
Yeah, it's interesting because I fight myself and with clients sometimes about, for example, to me, um, there from time to time, dividend paying stocks are an enormous value and they are so consistent and the way they compound. And but it's not sexy and it's not flashy.
You're
So
not
it's not
getting
going to give you
30% returns.
right. It's not going to give you 30%. All you're looking for is if you get a 4% dividend, all you're looking for is 6% price appreciation over time on average, right? So it's not super exciting, right? It's kind of like they plod along, they make their cash flow, they pay you a nice dividend, and you on average will get, 4 to 5 to 6% per year over a long market cycle. Um, so having someone look at that type of strategy relative to, let's say, a NASDAQ type strategy where, well, I could have a stock double in price. You're right, you could. And you could also have one get cut in half. So part of it is a risk tolerance level, but part of it is also, I think that a lot of investors nowadays have become so accustomed to searching out the very, very volatile, the very, very growth oriented, the very, very um, kind of sexy theme that I think a lot of these, just consistent cash flow growers just get swept under the rug because they're
Mhm.
just not that fun to talk about. Um, and I think it's interesting because I think it's the same mental psychology between, putting a plan into place and just sticking with the plan or, that start stop mentality where, I take too much risk, I pull back, take too much risk, I pull back, or, I save too much. Well, I really needed some of that for my house, for house repairs. I put in too much savings. Well, then I pull some out because I need to go on vacation. Um, you know,
Mhm.
different habits, different people, different ways we can handle those situations for sure.
Right. Yes, absolutely. I mean, there's uh, different, like you said, different mentalities that people hold and that we can work with in lots of different ways. But there is also the fundamentals, right? It's like, here are the fundamentals: patience, time in the market, um, and what is actually important to you so that we can make sure that we're helping you towards that. So we got to build from the fundamentals and then we can really customize based on you and what matters to you and what your life story has been and who you want to help and all, what kind of legacy you want to leave, all of that fun stuff we get to, customize for you. But again, we got to have the basics. We got to have the fundamentals. The basement has to be nice and solid.
For sure. For sure.
Well, thank you, Brad, as always, for being here. Next week, I think you're going to be out next week, right? July
I will
17th.
not. My trip got canceled.
Oh,
So
well, I'm
I'm here
sorry. Okay. Well, we'll see you next week then. And we'll see what's come out. We should start seeing second quarter earnings, maybe have a little bit to talk about there, which I am curious. So I'll put a little like bug in here, a little pin that, we were really unsure in the first quarter earnings, a lot of companies suspended guidance. So we got a lot of that happening in, April of 2025. So I am super curious to see how things start shaking out, what things are looking like for this Q2 for a lot of those companies that said, we're not even gonna give you guidance. So it'll be interesting.
Yeah, we'll see how it all rolls because uh, again, I think it'll be interesting to see what they say about AI and inflation and tariffs in particular.
We will be here and we will talk about it. So thanks, Brad. See you next time.
Thanks. Okay.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.